it may make sense to look at, considering how you might be able to give retirement assets to charities and maybe keep some of the non-retirement assets for family, maybe to take advantage of a step up in basis or something along those lines. That may help significantly in terms of total taxes. We are back focused on jobs and inflation this week. I'm Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue, and our goal is to leave you feeling more empowered each week with some of these market news updates, trends that we're watching, and our intention is to try and leave out some of the noise along the way. So we have actually quite a bit to cover, but all of it very, very relevant. We'll talk a little bit about jobs. We'll talk a little about inflation. We'll talk a little bit about this Trump and Xi summit that is happening right now. And then we'll wrap up with a great question of the week, which is around charitable considerations. We've had a lot of these questions come up lately, and so I want to make sure to touch on that real quick as well. So stepping all the way back, I want to start with actually last Friday, where we'll kind of kick things off here for this week's update. Last Friday, we had finished up jobs week. So last Friday, we got the employment report and the unemployment rate. The employment report was a pretty pleasant surprise, showing that we added 115,000 jobs. But for what it's worth, keep this in mind that, we're kind of in this weird phase still where good jobs numbers also gives the market a bit of a pause concern because the market is also looking at what the Fed may do. And if the labor market is strong and obviously inflation remains high, it's very unlikely that we see further cuts moving forward. We also saw the unemployment rate steady at 4.3%. So good news there, but not a whole lot to write home about. It's just been kind of remaining steady at that level. But that is where at least Powell was very focused towards the end of his term. We'll see what that means for worse here, assuming it's worse, as we get a little further along as well. Fast forward to this week, we had CPI and PPI data come out. So basically inflation. On Tuesday, we had CPI up 0.6% and core up 0.4%. Both of these were in line with expectations. So really not a lot to be too concerned about at the moment here, although it is a higher inflation number. Just keep in mind this is generally expected given what's been happening around Iran and all the above. So this was generally in line with expectations, but of course the story remains that we have elevated inflation, and for those who tune in pretty regularly, not something that we necessarily see going away anytime soon. However, the core number is I think the more important one to watch, because that headline number is going to fluctuate quite a bit, especially with what's going on right now in Iran. Wednesday, we had PPI come out, and PPI, the headline number, was up 1.4%. Core was up 0.6%. And then today we had retail sales. Retail sales were up 0.5%, kind of right in line with expectation. Still shows the consumer strength, although obviously there are segments of that, but generally shows consumer strength. And then fast forward to, I guess, last night, starting today, obviously there is, Trump has traveled over to China, and we have the summit going on. And basically, it's still really early in seeing where this all what this all translates to. But the short version of it is that there's a couple things that maybe are important to highlight so far. One is that there's talks or reports that basically both of them agree that we really shouldn't, or Iran, really shouldn't control the Strait of Hormuz. So, that's a good sign just in terms of less contention between the two countries there on the general approach to the Strait of Hormuz and what's going on overseas there. Second thing is that it seems so far that the news is generally suggesting maybe a more cordial visit, maybe a path towards more partnership between both China and US. So we will see how that translates. Again, obviously, it's still very early in this summit and the news stories that are coming out of it. But generally, so far, I would say it seems to be a little bit more in alignment than prior US and China conversations, which obviously does matter quite a bit. So we'll see where this takes us, and we'll be sure to keep you updated as we have more data. Be sure to tune in next week before we get to the question of the week. Next week, we will be covering any follow-up news stories from this summit. We'll also cover the Fed meeting minutes and housing data. But before we break for the week, really, again, relevant question of the week that we have around charitable considerations, because we've had a lot of questions around this lately, and typically These come up a little bit more closer to the end of the year, but it's not a year-end thing necessarily. And given that we've had so many questions, I thought it might be helpful to cover what to consider here. So what I want to maybe highlight is just, first off, that there are a lot of strategies to consider when you're looking at charitable giving. And given that the standard deduction is so much higher now, it does make your charitable contributions, it does require a little more strategy in how you approach them in order to get the largest tax benefit from them. Now, tax benefits are not a reason to give, of course. Charitable gifting, first and foremost, comes from the desire to want to give to these charities of interest. But, if you are going to, obviously there are some strategies that may help you more advantageously from a tax perspective that just requires some more thought rather than just kind of giving year to year, generally speaking. So a couple things to be aware of. There are just some of these general topics that we talk about a lot. QCDs is one that comes up a lot, qualified charitable distributions, which basically suggests that as you get past age 70 and a half, you can give directly from your retirement accounts to the charity of your choosing, which helps significantly from a tax perspective because it doesn't actually hit your income essentially. Second is donor advised funds. These are relatively new, but certainly something that's been around for a while. But basically this allows you to give to a donor advised fund and not necessarily to the charity yet, but still recognize all the charitable benefits of that contribution. So basically this is a great way for those who are trying to take advantage of the tax benefits, but maybe not give enough annually. You could potentially give more in one given year and then give from that donor advised fund annually, but at least get the tax benefits of the upfront gift. Appreciated stock is another one that's really helpful. So if you have, a position that has grown significantly, that can definitely play a role. There are charitable trusts out there, which certainly can help as well, depending on whether you need the assets or not, which is a big factor in any charitable trust. But what I wanted to also cover is one of the biggest mistakes that we see. I think this is one thing that comes up quite a bit. One of the things that we see most often for folks that come to us as new clients that have been charitably inclined is that we often see that they default to giving charitably from their non-retirement assets. Doesn't mean that never should be the case, but it's almost like a default where a lot of folks, I think, give directly from those assets without much thought into how maybe their retirement assets in combination might play a bigger role on their charitable interest as well as their state interest. Because keep in mind, when retirement assets, for instance, or let's say pre-tax retirement assets, go to a charity, the charity, excuse me, does not pay taxes, right? I mean, it's assuming it's a 501c3, and so that may benefit or benefit you in terms of what you give to charity, whereas your kids, of course, do pay taxes on any assets that they're given. So a lot of times it may make sense to look at, considering how you might be able to give retirement assets to charities and maybe keep some of the non-retirement assets for family, maybe to take advantage of a step up in basis or something along those lines. That may help significantly in terms of total taxes, whereas an IRA, of course, when it goes to your kids, for instance, they might pay ordinary income taxes, generally speaking, on the distributions. On non-retirement assets, generally speaking, they may get a step up in basis on any appreciated assets in there, and then can decide what to do from there moving forward. So keep in mind, especially when we're talking about this kind of marriage between charitable giving and estate planning, there is a lot to consider. So this is never a one size fits all by any means. But a lot of times what we find is this is kind of the most common mistake, is this default to giving directly from non-retirement assets. And although that may still be effective, it's definitely worth looking at this from a bigger picture view and just make sure we have a thoughtful plan around it as well. So hopefully that helps. We will leave it at that for today, but be sure to tune in next week. Again, we have the Fed meeting minutes, any follow-up news stories out of this summit in China, and then of course housing data as well. In the meantime, have a great upcoming weekend, and we will see you next Thursday at 3.